Actually, I'm just going to press record now. We'll be recording it, so those that couldn't get in.
I was intending to record it. Now I am going to record it.
No one heard that bit, so that's okay. So yeah, we'll be recording it for prosperity, for my faux pas, but also so that those that haven't got the chance to be here today will get the chance to listen to it at a later date. The other thing I'm going to say, we've got some questions that are going to come throughout this. There's obviously the Q&A function, which some of you have already found. As we go through this, you've got the opportunity to ask questions, beg your pardon, of the speakers, and at the end of it we'll have a Q&A session and you can vote the questions up. So those questions, keep them coming, and we'll start using that to ask questions of the speakers. There's also going to be a couple of poll questions that will be launched through this hour, which will be relevant for this particular session. I'd ask you, when you get the request to respond to the poll, please do, and we'll share those results as well. And the only other thing I'd say is, once this is all done, you'll get an email in probably 2 days' time, asking you for any feedback, asking you for what you thought of this, whether it was good, whether it was bad, whether you'd want to do it again. So if you get the chance to respond to that, I'd appreciate it. Tina, do you want to say anything before we introduce the speakers?
Yeah, thanks, Dan. Hi, everyone. Nice to see so many friendly faces. Well, here, see your names anyway. So I hope you enjoyed today's session. And obviously, we've got another 5. And thanks to Dan for doing all the tech side of things and how to master Zoom as well. So I had a look back when the first Marketing Procurement Conference was. It was in 2006. It was a SIPS one. And sadly, I found a CD today, which I then remembered how to insert into my computer. But it's really weird. The topics on it were How to Buy Digital, Magic and Logic, which obviously came out in June 2006. Sir Martin Sorrell calling for media transparency, and this is 14 years ago. And an agency chief, Murray MSC Sarchi, basically having a go at procurement about don't focus on cost cutting. So that's amazing. That was 14 years ago. And here we are today. So no, it's brilliant that we managed to pull this together. Thanks everyone for your support. And today, thanks Alex and Michael for today. I think it's going to be a great session to kick off with. And a few words from my friend Kevin Duncan, who's got a book called Business Bullshit. He's just updated it for COVID-19. So look out for ruminating, which is when you're not ignoring the panelists and investigating what's behind them. So I'm interested in Michael's case, San Francisco, and Zoomingo. So those of you naughty ones out there that are playing lockdown bingo when we have these sessions. So look out for ruminating and Zoomingo. So enjoy. Thanks for being here today, and we hope you enjoy the sessions.
I like that. That's good. Well, I'll help them with their Zoomingo. So I'm going to say the new normal now. So I think if we get that out there, take that box off, because that's going to definitely take some stage. All right. So all right, as we go into these sessions, I'm going to introduce you to the 2 speakers for today. So we've got Alex and Michael. Alex was a highly rated sell-side media and internet sector analyst and worked in equity capital markets for a number of European investment banks between 1997 and 2018, although you wouldn't think it to look at him, he's old enough. That included ING, Credit Agricole, Lazards, Panmure Gordon and Peel Hunt. After a sabbatical, he became an advisor in 2019 to the London-based boutique investment firms Trillium Partners and Radnor Capital. In addition to that, he's an investor and a mentor to a number of startups in the media and tech sectors. He contributes regularly on sector matters in media publications like The Guardian, FT, Bloomberg, Campaign, and Digiday. And Michael, I still look at that photo of you. It's fantastic. The one online. You look like a baby.
I don't look that much worse. I hope I don't look that much worse.
So Michael is a senior research analyst focused on the internet and media sectors. Prior to joining Pivotal Research, he spent 10 years working in the buy side, focusing on global tech, media, and telco sectors at Fortress Investment, Carabel Capital, and AO Asset Management. Prior to investing, Michael spent 9 years working in senior management in the internet industry, specializing in consumer internet and SaaS, including at Yahoo as a director of strategic alliances, and he led the launch of the strategic services division at Core Metrics. I'm going to leave this to you guys. We are going to actually turn our cameras off so that you don't have to look at our ugly mugs anymore. And I can. As we said, if you want to keep using that question session on the right hand side, keep putting your questions up, and the poll will be coming out as well. I'll hand over to you guys. I think Alex, you're going to start us off.
Thank you very much. Let me just share my deck with everybody. Okay. So I think the way Michael and I are going to do this is to have 25, 30 minutes on the sector and the market and the macro side of things. And we're probably going to freestyle it overall, but we have put together, or I've put together a deck, which is a bit of a mashup from lots of different sources. So please bear that in mind. And I borrowed liberally from the likes of Bloomberg, a number of investment banks, and the corporates, WPP and S4 Capital, both of which are listed here in the UK, big players in media and marcoms. But we don't want to make it overly formal, so I think Michael's going to kick in frequently, and then I guess at the end of our piece there'll be time for Q&A. So I've put together a dozen slides, which I'm going to rip through quite quickly just now. I hope you can see them all. If there are any tech issues, just let me know. And we're going to start here. Michael, can you see everything
I can.
I'm producing? Please jump in with any thoughts, comments, or critiques. So I'm conscious of the fact that the audience is procurement guys. So you're maybe not as market focused in a way as Michael and I would be, and that's probably a good thing. Good for you, because you're living in the real world and we're living in the crazy world which is called markets. But nonetheless, markets have been pretty volatile year to date, and of course the big issue is COVID. And I just wanted to give everybody some context. A lot of my slides are quite UK centric, so again, if Michael's got a particular US or global angle, please kick in. But these two charts on the left and the right give you a feel for the scale of what we're witnessing this year in terms of the slump. And obviously the shocking headline there on the left, worst since 1706. So that's basically the UK GDP growth profile over 300 years, hitting the buffers big time in March 2020. And the latest estimates for the UK are that we're probably going to be down high single digits, low double digits, 2010 in terms of growth year on year, as COVID really hits in with lockdown. And you can see on the right-hand side with the global slump that really the story is similar wherever you are. China was early in, followed by Europe. And I guess, Michael, would you say the US was a little bit behind in terms of the impact?
Yeah, I think that's probably fair. I mean, just even seeing from some of the companies I cover who publicly reported, most don't actually have a lot of China exposure, but you could definitely see the Eurozone impact showing up more in Q1 numbers, and it really feels like things really hit the fan in the US. Called somewhere between like March 8th and March 15th is when I started to hear people having their holy shit moment, like, hit the stop button, like, let's start figuring out meaningful, scenario planning and, what does this mean? How bad can it be?
I absolutely agree. From my perspective, with the UK hat on, we were pretty much good to go until, I would say, that second week of March. But then really events stopped taking place, travel became more difficult, companies began to warn, but not at that stage withdraw guidance. One of the telltale signs for me was that companies back end of March, early April, began to withdraw guidance, just as the magnitude of what we've seen became apparent. These two slides,
Alex, on guidance, the one that really turned my head was, Booking.com, obviously the biggest travel player and the most disrupted sector globally, literally guided beyond abysmally at the end of February based on what they were already seeing, and then withdrew their guidance 2 weeks later. Which to me suggests, I don't formally cover the company now. I did on the buy side, so I know them very well, and I'm like, that must just, literally they may still have absolutely zero visibility. So,
yeah,
and I think that was, they probably felt it the worst, but pretty consistent where when folks just didn't know, is business trending down 20%, 30%, 40%, very, very hard to put your foot in and turn the on switch on again. So pretty shocking degree of declines into the end of March that persisted through April.
Yeah, I mean, to that point you make there, Michael, about travel and Booking.com, and of course, discretionary expenditure for consumers is all about traveling and tourism. And you can see, guys, here on the left-hand side, chart 3, which is sourced from the World Bank, just how exposed, for example, a lot of the European economies are to travel and tourism as a percentage of GDP. Very exposed, very dependent upon, the seasonal flow of travel. And of course, these economies are going to be suffering big time with lockdown. Effectively, certainly in the Eurozone, very little in the way of travel. I think they aspire to get flights up and running in early July, but that basically means that for Q2 this year, there'll have been very little tourism taking place. And for many of these countries, it's a really big employment sector, but it's also a big wealth creator. I pulled from Bloomberg. Michael's probably better talking to this slide than I am, but for me, one of the telltale signs in any recession or any, downturn is what the small business guys are saying, because ultimately they probably don't get talked about enough, but they give you a feel for what's happening on the ground, and you can see here that sales expectations are lowest since 1986, just to put it into some context. Does that tell you?
And this to me is like, looking at the large internet companies. I mean, I don't know how much, how similarly it's been felt in Europe, but in my estimates, SMBs basically represent a fairly large chunk of both Google and Facebook revenues. I mean, all things considered, I would say Google even pacing down high teens into 2Q, considering travel's probably, 8 to 9% of their revenues, and that's down 90. Like, I actually even thought those were heroic results. And I mean, Facebook pacing flat was probably by far the biggest shocker coming out of earnings season. I mean, doesn't mean all these things are going to be where numbers end up for the quarter, and still hard to figure out the slope of recovery. But something to note, especially for folks in procurement. I mean, look, both companies increased pretty substantially their provision for bad debt, and my suspicion is that really was talking to them, a snapshot in time. So I bet that number is going to look pretty ugly when we see the 2Q results, because there's this massive amount. If folks have been following the jobless loss in the States, my guess is after tomorrow we're probably approaching 16-17% unemployment, which is somewhat unheard of.
Yeah, I mean, that brings us to this slide here, guys, which is spenders of the last resort, which just shows the extent to which in pretty much every big economic area globally, the government has stepped in to fill the gap in terms of consumers and households and small businesses. And I can tell you that here in the UK, for example, right now, approximately 8 million of our 25 million workforce are being paid by the government. I mean, that's totally unprecedented. It's never happened before. And of course, what we have here in the UK, which I think you have in the US and certainly in many other countries, we have the furlough scheme, whereby the government effectively backstops 75-80% of the employment costs for most private sector employers. That has an enormous cost, and that's reflected in these red bars, which are showing such a sharp drop for 2020. As you can see, the government picks up the tab effectively for again, the lockdown. Michael, is this consistent with what you're seeing in terms of US unemployment, furlough, and sort of the state picking up the tab, I guess?
Yeah, I am, and I'll tell you, it's an interesting dynamic as we're talking about consumption, because basically for most states in the US, I mean, there's a huge amount of furlough activity. You can see it happening in hospitality, in retail. I personally have a lot of question marks certainly within retail, if these companies are ever going to reopen. And there's been a number of large, storied brands that have already declared bankruptcy in the US. But the interesting dynamic, and we'll see what the world looks like in July, is you basically are probably as called a minimum wage employee, which is a very large percentage of the US, you're probably making more now than you actually were while you were employed. So you got a little bit of a perverse bias. And then the other thing, and it's interesting, it's partly why I feel like internet's been just absolutely crushing it on the e-commerce side. I think this is a step function forward of driving adoption. And I think it actually also explains a lot about Facebook being as resilient as they are. Because I personally, having lived through a couple rounds of internet bubbles, I've been skeptical about some of these direct-to-consumer brands where people are thinking about market share shift and whatnot. It's kind of like newly created money, where it's just sell women's swimsuits or cold coffee subscriptions for $60. And like, so the interesting thing for folks with higher net income is, to your point that you were making, Alex, when it comes to things basically like travel, I go down the list and I'm like, what are the things discretionarily that I would actually spend money on? And it's basically travel, eating out, and entertainment. So in some regards, like you may actually see a scenario where the government, as strong feelings as people may have about Trump, what I think they've done is just sort of shock and awe in terms of financial support, both from just a pure out monetarily as well as to central bank moves, is probably going to make the consumption declines much less painful than the actual GDP declines.
Mm-hmm.
But at some point, you got a credit card bill, and that's gonna, that's basically gonna have to, it's gonna have to get paid. So
this slide here, guys, is from the FT. I won't dwell on it because it's a pretty painful slide, but just gives you a feel for what's happened in terms of the dramatic increase in joblessness in the States. I think we've probably covered this off, Michael, unless you already have some additional comments on the shape of that.
yeah.
What might expectations be for Q3 or what follows on from here?
Look, the second derivative better get better.
Yeah.
Gradual reopening happening at this point. That's the hope. But just every vignette you hear, like, it doesn't. When the interesting thing is, people talk a lot about China, and I've done a lot over, in that vertical too, and just hearing what the companies are saying. E-commerce is having a step function change. Gaming is having a step function change. Like, in people, they're not going back out and eating in restaurants. I'll be curious. They reopen Shanghai Disney. Like, how much will folks sit there and being like, wow, I got to run back to go to a crowded theme park? For social distancing will probably be a very challenging thing to go ahead and overcome. Got
it. So for the guys maybe with the markets hat on, these two slides I think are quite interesting. On the left-hand side, basically showing that, and this is a little bit out of date because it takes it to the end of April, but it basically reflects the fact that the big internet names have, to use Michael's expression, absolutely crushed it, and their stock price performance has been, as a basket, has been very strong, and relative to the market even stronger. And I guess that reflects, safe haven status and the fact that e-commerce has been very robust through this period of lockdown. One of the things I get asked a lot by my friends and family who maybe aren't exposed to the investment world in the way that sort of, Michael and I would be, is how can the market be so strong? There's so much bad news out there. So many people are losing their jobs. Company earnings are getting smashed. How can the market only be down like 10% year to date? And of course, liquidity is one reason. There's been a lot of stimulus, but the fact that the big internet names have just continued to perform well.
Well, just to clarify though, Alex, believe me, the numbers are still, in absolute terms, the numbers are pretty darn bad at Facebook and Google. I think expectations definitely got a lot more negative. I think a lot of people were surprised at how, look, there was a trade that was working very, very well, which was short online advertising, be long e-commerce, be short online travel. And then Snapchat reported, and people just had taken their numbers down too far. The one I would highlight, Amazon has obviously been a huge beneficiary. It's going to come at a major cost with profits, but investors are largely looking through that. As a comment that Satya made on the Microsoft earnings call, and all the software names who've been reporting, they're just talking about, you've had several years of digital transformation get accelerated over the course of a couple months. So, to me, some of it with the internet was just, people thought it was going to be meaningfully worse, present company included. And, And I mean, and look, and I still am of the view that I think extrapolating anything with brand advertising as being a V for recovery is going to be very disappointing to folks. And at least what I'm hearing so far is like, yeah, it's like, okay, April was probably the bottom, and May's a bit better than, you know, than April, and we hope June is going to be better too. But I'm hearing from clients and agencies, they're just like, look, we're we're allocating like and making decisions on a weekly basis still. And like, yes, the visibility is improved, and at least for bolstering Facebook, which, you know, a flat run rate for April was pretty shocking. Part of what I think has driven that, which I was referencing before, was, you know, I'm talking to guys who you know, agencies who work with these DTC brands. So you've had pricing basically down somewhere between 30 to 35%, and you actually, even net of whatever the cost per, you know, per visit translates into, you're getting great conversions. Because it's kind of like, you know, home shopping network, like you're stuck at home, buy this set of steak knives, you know, order now and get a third one. Like, so they've been sort of shocked at the resilience. Like I'm still kind of trying to wrap my head around it. It's been very, very true in gaming as well. Gaming, I think, and Facebook sort of acknowledged that probably as the world opens back up. I can't tell, but e-commerce, at least my personal view is, we just had a step function change. I mean, all the companies that reported, like a big company called Shopify that helps third party, you know, which has really crushed it as a stock. Like, you know, basically message I've had to the market is like, if you haven't figured out e-commerce, like you better figure it out like yesterday. You know, there's sort of no choice. So companies like them and GoDaddy and Wix, you know, that all helps businesses get up and going, or just, you know, or having guys get live and running in record speed.
Is there a cloud computing angle as well, Michael, in terms of go forward trends which would benefit some of these guys?
Yeah, definitely. I'd say cloud numbers were very strong for both Azure and for Google Cloud. My suspicion is Google's really the upstart in the equation, and at least just having been a guy in sales prior point in my career, like I always feel like when you're the upstart, when you're first basically getting a deal done, I feel like having that meal with your client, having drinks as you're trying to basically close deal and you're trying to figure out other sell and reference points within the organization, I think that's more important. So probably Azure and Amazon are a little bit further along. I mean, the Amazon numbers were, call it maybe marginally disappointing. But what I'd also say is, like, Amazon is public cloud, you know, so they were framing for me, look, we got clients who are up, clients who are basically up triple digits week over week. And then they also have exposure to the travel sector where volumes are down 90%. You know, so like when you're them, you basically can't avoid some of the weakness.
Yeah, no, point taken. Guys, also just very quickly in passing, draw your attention to the slide on the right, which is the financing slide for US and European corporates. It may be a subtle point, but one of the reasons why I think the US could recover quicker than other continents and other economic areas is just to make the point that in Europe, including the UK, we're still very dependent on banks for financing. And our banks move pretty slowly, quite frankly, whereas I think in the US, capital markets are a little bit more sophisticated, slightly different sources of capital, slightly less dependent upon banks. And so I think the US, from my point of view, in terms of the health of its corporates, is probably a step ahead of Europe, but that's for another occasion. I guess this next slide is the one where really we could argue all day or talk all day, but this will be the one where everyone on this call will have a view, and the view is basically what sort of recovery are we in for? And all I've done here really is depict on the left and the right hopes for a V shape by geography, with the bottom of the V being in April, May 20, so now, and the bounce back potential into next year. And then on the right-hand side, a slightly more nuanced approach, which is to say that, well, actually, is the V shape a bit naive? Is it a bit, what's the probability of that? And if we don't get a V, what do we get instead? Do we get a U, or worst case scenario, or nearly worst case scenario, do we get an L? And in an L-shaped scenario, we don't really get a recovery. We just get a pretty sluggish outlook for 2 to 3 years further out. So for what it's worth, my own view, everybody's got a view, my view is that we're probably somewhere between a V and a U in terms of recovery potential. I think, he says, crossing everything, hope that an L shape is a relatively low probability, but that will be a function, quite frankly, of how as a world we get on top of coronavirus, and how quickly we can emerge continuously from lockdown and restore sort of normal measures of economic activity. But this is the big debate, isn't it, Michael? I think in investment.
Yeah, 100%. And post the quarter, everybody basically has got 2Q models as the trough, you know, with the rates that people have gotten for the month of April. Some companies have been more helpful than others, like Viacom. They wouldn't even tell you how bad it is, but you're seeing down 30 to 50%. And it's like, oh, you know, basically, you know, second quarter will be better than first quarter. It's like, okay, good for you, man. So I would say I probably sit more likely. I think L feels pretty unlikely, with the exception of, look, I mean, I'm trying to be optimistic about a vaccine. And for what it's worth, a lot of the marketers who I talk to, I mean, look, some of the decisions they're making, at least in the US, is driven by what, you know, it's going to be, are the consumers there? And basically, are the states opening? So is there a reason for me to advertise? I'm a little bit nervous about, I'm nervous that reopening. I think we've done, quite frankly, an abysmal job as a country relative. I mean, one of my closest friends who's married to a German woman just flew there, and, you know, and like things are reopening. People are living normal lives, right? Like where my suspicion is we'll continue to open too early here. And I just read enough of things from the medical experts saying that this is going to come back in the fall. Even if they find a vaccine, most medical folks I've talked to have said, let's say they find it tomorrow. I think the earliest you're going to get back to, you know, get to a point that could be a globalized production scale and really out there, probably middle of 21, best case. And you know, my view is that a lot of CFOs, a lot of CMOs who probably are, you know, they may be saying like, look, we want to spend more, but some of the smarter ones are like, look, we get it, we're the natural hedge. And, you know, so the CFO is just like, look, man, I'm not making some big commitment. Like you know, I just hear that across the board, which makes me skeptical about the television upfronts, how well that's basically going to go. And, you know, I think for the agencies, I think it's going to be more sort of project-esque versus not. I would just, at least within media, I will be very surprised if it's, I feel like our best case is it's a U, and people probably mildly get disappointed with the rate of recovery. But with all the liquidity that the Fed's provided, I mean, the number one thing I think investors sometimes miss is you can't fight central banks. So like you're seeing multiples in some of these stocks are expanding towards their highs. It actually makes plenty of sense to me. You know, the risk is just, it lags on longer than, you know, than folks appreciate. But, you know, gun to head right now, I would say, I think we're in a U, and I think we'll be in the bottom part of the U for a longer period of time than public markets will find, you know, palatable given the recovery the market's had off of its lows. I think we probably see the lows in the market, but like, do I think we probably are going to have a pullback in another round of disappointments? Yeah, I kind of do.
I mean, there maybe is also a fourth type of recovery, which is a W recovery.
Yeah.
I'm sure you guys have talked to in the States, which maybe is more realistic than anything, because W, of course, as a shape, gives you the impression of a zigzag recovery.
Yeah.
In other words, up and down, not a lot of confidence over the sort of continuous nature of the recovery, the potential for things to slip up again. So that's maybe a fourth type of recovery in terms of the shape, not depicted here, but one to talk about. That's pretty much it in terms of the macro from my point of view. I put this slide up here, which I pinched from Morgan Stanley. It uses China as a roadmap. I'm not really sure how valid that is, but it does feel as though they are in some ways ahead in terms of lockdown process since lockdown. I don't know if it's a really valid comparator, but gives you a feel for how they're playing with social distancing. You might need to blow this slide up a little bit to actually see the detail on the timelines. This is one I stole from LionTree, which is a firm which Mike will know well, and he'll probably be better off talking to this than me in a way. But just on the left-hand side, you'll just see how within our sector, our media space, internet space, as of 3 or 4 weeks ago, these were the percentage trends in terms of stocks and their exposure to social distancing. And you can see at the top that, frankly, social interaction names that had theatre or out-of-home exposure were really getting hit hard. Have these trends stuck, Michael, or would you see, has there been a pickup in the last couple of weeks? Because this data was pulled off 2 or 3 weeks ago.
I mean, there literally was yesterday. Just
Yeah.
when it was, which tells you a lot about how people are positioned in the stock market, where, we're basically, more of an update came out about Moderna being farther down the line with regards to a vaccine. And then sort of not surprisingly, stocks like Zoom, which we're all on, is benefited a lot. Like the e-commerce names were down, and, like Viacom's up a ton, Live Nation is, and look, and that probably will be, some of that's retail driving, some of that's larger fund positioning. But at least it helps you on days like yesterday. I mean, having been a buy side guy, I'm like, that's when you basically get to see where the bodies are buried. But look, quite frankly, I don't see how theaters basically survive. I think it's going to be very challenging. I think, out of home advertising, I bet you actually has a really nice bump once people do start getting out and we get to resumption of normalcy. But travel, I mean, look, it's like, I've had a view for a while on at least that business travel will have secularly changed from this. Every CFO, every company I've talked to is beyond reinforced that, like, why the hell is T&E gonna ever go back to where it was? If you're a CFO, you're like, well, that's easy, and sure, like execs will travel and some of the sales folks will. There'll be some critical need, but if for the most part you can, accomplish more online, it's like, all right, that makes sense. And look, in the States at least, Live Nation basically dominates the ticketing franchise, and I just personally, my view is lacking a, they don't have a lot of leverage. At least there's not a debt issue, but like lacking a vaccine, with wide rollout, I can't imagine who the hell is actually going to go to a sporting event or a live concert event. Like, it just feels exceptionally unlikely.
Yeah, you mentioned Germany and your friend. I mean, over here in Europe, in Germany, just this last weekend, we've had a resumption of live soccer, but without any crowds, without any people in the stadium. So it's a pretty sterile experience, and I don't think there's any
expectation. People like it? Were people still psyched to have something to watch?
Yeah, I mean, I don't think there's any expectation in Europe of crowds coming back this year, frankly.
I mean, they're planning the same in the States. They're trying to get baseball going in NFL, but those are very, very large. There's a lot of money at stake for television, for the leagues. So, and they're already going to take a hit if they aren't basically viewed live. But I think they're sort of desperate, and who knows? I mean, I guess folks will get used to anything. It's better. It's probably better than nothing. But I know at least the feedback, from some of the players are just like, we sort of rely on that, on that feedback loop. So it just may not be as much fun, but we'll see. And look, the big question, I don't know how much it's getting asked in Europe, like already some of the colleges in the US are basically saying there's no live school starting in the fall, which is massively, massively disruptive. Like, huge disruptive.
Yeah, it's going to play out over the second half. This is a slide I pulled from WPP, big advertising group that we all know. Nothing controversial about this slide. Just tells you what they've seen from clients so far in terms of reallocating media behavior and spend, looking to generate ROI. No surprise, traditional sectors way down and digital way up, and national TV flattish. That's, I guess, what you would expect. But of course, the question is whether or not these big holding companies are as relevant today as they would have been in previous downturns, maybe 10, 15 years ago. So that's
I think it's bad, man. I mean, think about this, like for context. We basically had peak GDP growth in 2019 in all likelihood. You know, maybe we'll get a recovery year off of a crappy year that'll be bigger, but you know, in terms of normalized 2-year GDP, and you were seeing these guys in the States doing on average 2% organic revenue growth. I mean, that's, to me, it's sort of like, and they're at a spot right now where they really don't have as much meat to be able to cut, right? So this, you know, this is now going to be, translating into reductions of scope, reduction of quality of work, and I bet it's a very good opportunity for the independents. I know you also, I mean, I talk and I've hosted quite a few events with the S4 guys. I mean, I have a huge degree of admiration for Sir Martin, who could have, quite frankly, if he wanted to, just said, I'm going to hang up my cleats, I'm done. And I think they're sort of basically building like the anti-holding company agency model, like recognizing where the holes live.
You're absolutely right. I mean, S4, I don't know how well it will be known on the call to some of the participants, but it's a challenger brand headquartered in the UK, but the assets are primarily in the States and Asia and a little bit in mainland Europe. And they're a play on data, content, and programmatic. Their trends are a lot better, perhaps, than some of the more traditional agency groups. They don't have as much legacy as those groups, and they're more confident going into this COVID downturn. So I've just added on the back of this slide deck, I've added some comments from them. I mean, this is fairly standard corporate behavior when you hit the buffers like we have done recently. And this is what they're doing: drawing down their revolving credit facility, focusing intensely on cash. Unlike a lot of corporates, they're not really getting into bed with the state or the government in terms of anything other than tax, and of course, for the time being, cutting bonuses. So liquidity is the big issue, and I won't go on about these slides because they're self-explanatory, but it sort of shows how they're tackling what clients are doing in terms of their COVID-19 command center. But I won't. You can read that at your leisure. So I think in conclusion, my sense, Michael, my sense would be probably between a V and a U in terms of the recovery, and it's all about the safety and the speed with which we emerge from lockdown. And the lasting implication probably is that digital takes share, which it was doing anyway, but it takes it more quickly.
I tend to agree. I definitely tend to agree. I mean, I think that basically the way the TV companies in the States have handled things with the upfront, and I gotta say, I don't formally cover them, although I talk to folks at a lot of the companies since I covered them on the buy side for years, which actually probably makes my having conversations with them easier because I'm not overtly writing about them. I'm just sort of surprised that it's such a long-term game where you negotiate with the same folks year after year. And I'm sitting here and seeing advertisements for Carnival Cruises, who's basically could be on the brink of bankruptcy, still running during CNBC. And so on top of everything else in terms of the share shift, I'm like, are you literally going to hold people to their commitments, where the advice I've given to Snapchat, Pinterest, and Twitter pretty overtly, because the non-must-buy guys who will be Google and Facebook, and in some cases Amazon, depending on the advertiser, like I just told them, like, be a good partner. You know what I mean? Like, don't get bitter. Don't be as focused on revenues. Like, focus on, we get it. You're struggling. We're there. This is a long-term relationship. And those to me are the guys who are going to end up back on the plan. And I've been asking some of the Q&A respondents, and it's a mess. I think it's a total mess.
Okay. Right, guys, I'm sorry to cut in.
Yeah, sure.
I could sit here and listen to you two go on all day, but unfortunately, we've only got about another 15 minutes left, and I'd love to get to some Q&A.
Sure.
We've had some really good questions coming in. We've also had some poll response. I'm going to actually launch the next poll now. I'll let that go out there, and then we'll see where that goes. One of the questions that came in from Laura in the US is, what categories do you think are most likely to lean into the recession and continue to invest in advertising? So, it's interesting. Both Tina and I have spent time over the last couple of weeks, probably months now, doing an online mini MBA with Mark Ritson, and I'm sure many know who Mark Ritson is, and he goes on and on and on and on about investing when everyone else isn't, and getting your kind of excess share of voice off the back of it, and why it's a good investment decision if you can do it. The question is, which categories do you think are gonna do that over the coming months and years?
I mean, the few that I've seen, the most obvious one has really been CPG.
Yeah.
That I think hasn't necessarily been as impacted. If anything, I think they've benefited quite a bit. So I think you'll see a continual lean in there. For me, a big question mark is about these DTC brands that simply just didn't exist. So it's not even like a share shift. It's like these guys who are selling, subscriptions to cold brew coffee and the 9th pair of different sweatpants that I personally, if it's VC funded, look, after seeing what happened with, the biggest notable one to me was Casper, the IPO of Casper, where I'm like, look, you guys don't know how to think about marketing. I'm like, basically, like, let me spend a bunch of money marketing for something that you buy once every 10 years. Like, that's the dumbest thing I've ever heard in my life. And these guys went out, the banker still took them public. And it was, to me, a company that raised money from VCs in March of 2019 at 1.2 billion, very quickly realized, like, there's nowhere else to raise money. And I can tell you, having dealt with public market companies at $500 million market caps, it's just an utter waste of your time. So what I can't tell is, as the recovery proceeds on pricing on Facebook, the way they've just been describing it to me is, it's Christmas early. I don't know what happens there, because I still think brand's going to be soft and take a while. And if people start going back out in the world, I think the nuances on Facebook around, like, the gaming auction, like, that's a very specific category people are trying to go after. So it really is to me CPG, and I guess I also am seeing tech lean in. Auto's sort of a little bit is not gotten, like, blown up, and they're definitely, and very quickly changed their message in terms of, look, we're gonna, like, we understand where you are, we're gonna waive a couple lease payments, and that I would expect basically continues. But a lot of guys are watching all the same stats and shit we all are every day, and just seeing what happens with openings. And when I see, like, a huge respondent set, and I do the survey to 55 large agencies and advertisers, saying a lot of planning is still getting done week to week, it just says to me, folks don't have a ton of visibility. So it really is a pretty small set. That could get wider. But look, even Amazon, I mean, Amazon's had a supply delivery constraint. Like, they pulled back on spending probably $500 to $800 million on Google. They just turned it off. They're just like, we don't need the traffic. Like, what? Like, why? So
that's fair. What do you think, Alex?
Yeah, I mean, CPG and gaming, agreed. Healthcare, wellness.
Yeah.
Yeah, I forget healthcare.
I think, particularly with what's going on, I think they get an extra tick in the box from the CMO there. and maybe bits of financial services.
Okay. Okay.
So I guess I'm thinking very similar to Michael, but maybe bolting on healthcare and financial services.
Yeah, I agree with healthcare. I forgot to mention that one. I don't talk to that category as often, but
so just on a quick one, we just launched a poll, and the question we asked the audience was: are you expecting to cut or limit your marketing investment over the coming year? The reason this is relevant is obvious. You know, these guys are having to control that spend. A lot of the people on the webinar, their role will be to help their organizations to continue to flourish under probably smaller budgets. What's worrying is that over half the respondents, probably more than that, are cutting more than 25%. Some are cutting most of it, and there's a pretty large amount of cutting 50% of it. Given that, Laura Facchetti from, I hope I've said that right, from the WFA has shared us some data as well, saying that research shows that the global average marketing budgets are down 36% first half of 2020 and 31% full year. So those numbers are dropping pretty quickly. One of the questions I had, and actually Debbie Morrison from used to be ISBA, now Ubiquity, has asked is, what's your prediction for agency consolidations? Because you and I spoke, we were setting this webinar up and we had a prep call. We had quite a long conversation about, you know, the last big failed consolidation between the agency groups was, I think we said it was 2016, 2017, something like that. Now, do we think that the marketplace is now ripe for another consolidation play, given where we stand? So, Alex, if you want to address that one first, that'd be great.
Yeah, sure. Well, I mean, the big holding companies, so WPP, Publicis, IPG, OMC, Dentsu, yeah, they need a solution to their problem, and the solution to the problem may be more scale and more cost savings. The problem is, in most cases, it's probably going to be like putting together two sort of slightly drunken old men.
Yeah.
Necessarily solve any problems.
Actually, not in some cases. That is exactly what it is.
that is exactly right.
Please don't repeat that analogy. So it's possible, but do you know what? I think they've got a lot going on within their own holding company structures. So I would imagine that internal restructuring will remain the key focus. That's my call for what it's worth. They need to do it, but I get the feeling internal restructuring will be the focus for the next 12 months.
Yeah. Okay. What about you, Michael? What do you think?
I agree. I don't know what they get. I don't know what they get out of it. You know, the wild card would basically be, do you see private equity at some point get involved? You know, Sir Martin's been very vocal saying he thinks Group M's worth 12 bill, which, you know, and probably isn't worth as much now. And, you know, so probably worth more than all of WPP, Pubco. Like, you know, I guess there's some things they can do in terms of spinoffs. You know, wild card would be for me if you saw, you know, one of the consulting companies decide to really make a bigger bite. But it's sort of like, I don't know, like, there's no way anybody's doing, like, everybody's stock price is heavily depressed. Like, so it's, you aren't going to sell, because you'll get massive shareholder lawsuits if you sell on the lows. And like, but the part that's so tricky for those guys is so much costs have already been taken out of the system. Yep. And while working remote is going to become a bigger deal, like even as you reopen, like I've heard at least one postulation, there'll be some places that'll say, screw it, I'm just going to let my guys just basically work remote. Look, I dealt a lot with the agency channel, and I sort of still do, but back to my Yahoo days, like just very often you're also talking about kids who are 24 to 27 years old. They may not be as exemplary or as well disciplined to work at home, you know, employee. And it's definitely impacted some of how I thought, if you're not on the must-buy list as we look through the pace of recovery, you know, favoring the larger guys. But like, you probably have to still have a decent amount of office space. And if anything, it's going to be even less efficient because you're going to have the way the layout is in the office space divided. You know, that's, I was sitting there thinking through, where else can these guys actually squeeze? Because they've already squeezed pretty hard. Like, it's sort of, I feel like they're sort of at the end of the rope of, sort of logical cost cuts, and now it's basically as companies are basically cutting marketing spends. I see from my data, it's just the shit's rolling downhill. I've asked this
and on that very happy analogy about the shit rolling downhill, let's bring procurement into this. Final question. Unfortunately, guys, we are running out of time, but I want to get this question in because you talk about shit rolling downhill. It tends to be the people at the bottom is procurement. They have to catch all that shit and clean it up. So despite the lurch to a short-term decisions on savings and sort of cutting costs, how important do you guys think it is that procurement maintain a long-term view to protect the future efficiency of business? So this is both. I mean, I actually think this is a double one. This is procurement have to do this, but obviously marketing have to do this as well. So what's your take on that one, Alex?
Yeah, I mean, you have to try and take a long-term view. My worry is that the sort of the magnitude of the downturn through Q2 may have led to some pretty rash decision making, which may play out through the balance of this year before common sense prevails and slightly more long-term thinking resumes. I wouldn't underestimate that shock impact. The other thing which I find a little bit disconcerting is when I read the trade press over the last 12 months, I've seen a number of stories about CMOs leaving, being asked to leave. And this is a position which I felt had made itself pretty secure in the C-suite, the CMO. And it just feels in the last 12 months as though that's not the case anymore, which I think is a little bit worrying because it sort of tells me that the CMO role is getting subsumed within the CTO or maybe the CFO role, and then marketing and maybe procurement takes a bit too much of a backseat at precisely the time when it needs to be pushing for that long-term vision. So I'm optimistic, but I'm conscious of the fact that we've had a pretty big shock to the system. So long-term thinking may not come to the fore just yet.
Okay. Well, look, guys, I hate to stop you at this, but it's 5-9 here in the US. We did say
I'd like to leave with one last little vignette, like because I got a cheery one because we've talked about a lot of negative things. Look, if I'm in procurement, this to me is your time to shine. I would be sitting there proactively reaching out to marketing and being like, if we're in a normalized world and we're thinking to 21, what are the marketing partners that we care about? And then literally, because I used to do customer acquisition, just beat the shit out of the other vendors. Like extend credit, and believe me, it's happening. Extend credit terms and go in, further your career proactively by going to whoever it is sort of within the organization, how you line up and being like, this is how I'm going to help save you money. Like
Michael's advice, if we kind of pass it down into one sentence, is beat the shit out of the other vendors.
Yeah, that's reality.
We like that.
That's great advice. All right, well,
I want to leave on a positive note, right? You know.
Yeah, very positive.
On that bombshell, I want to thank Michael and Alex so much for your time. This hour has gone by like this, and I've certainly been enthralled throughout. We've had a lot of interaction from people online. You'll all get an email within a day with Michael and Alex's details on if you want to follow up with some questions there, or Tina and I. Thank you so much for your time. And if those of you who have signed up for the following, the other 5 webinar sessions, they've got a lot to live up to now. So the next one in an hour's time will
which is me, about the pitches.
Tina and Megan McDonald from Parle & Company are going to talk to us about the pitch process, which I'm imagining there's going to be a few of them happening over the next year. So dial back in and we'll see you in an hour. And thank you so much, Alex and Michael. We'll see you.
Thanks, Dan. Thanks, Michael. Thanks, Tina. Thank you.
Guys. Hope it was helpful.